Hello, everyone, and welcome to another episode of the OKX Insights podcast, Send It. I'm your host today, Hunain Nasir, Senior Editor at OKX Insights, and I'm joined by my fellow Senior Editor, Adam James, and our Senior Analyst, Rick Delaney. Today, we are welcoming our special guest, Z, who is the lead on-chain analyst and a community manager at CryptoQuant. I will now send it to Z for a brief introduction and to kick this off. Hey, Z, thank you for joining us.
Hello, glad to be here. Yes, this is Z, and I'm really happy to be with you guys. I'm with CQ, and I'm an analyst there, and I'm glad to be here with you guys today.
So great. So Z, can you start with perhaps giving our audience kind of like a rundown of what on-chain data kind of means for the crypto markets and how it's been emerging recently, and what are the exciting things with it?
Sure. I think I better start with my screen just shared. That's easier for me to go that way. Well, I think this picture tells this story really well, and I just grabbed it from CQ Data Guide, so people can go refer to it and look at it if they want to after this podcast being recorded. What happened since 2010, 2011, like when the market was evolving and everyone talked about Bitcoin and everyone were speculating about the applications. Can it be like a cash system? Can it be like a person-to-person payment? One thing was growing and evolving, and that was on-chain data. And not everyone were talking about it. Like me, myself, I was all about just buying Bitcoin, looking at the price. But 2018 and 2017 was the moment I found out something named the on-chain data analyst. And I was just like not really fussy about it at the beginning. Then one of my friends is into like Bitcoin a lot, and he was talking about like this method is really different. You can be like a macroeconomic economist at this like field, and it really struck me that moment, and I started learning about it. So it was 2019 when I seriously thought about it. But this image is showing how on-chain data and how on-chain analysis just becoming a thing that we're seeing today. Started 2010 with basic data about the miners, and there was some data about how many Bitcoin being spent today, how big is the transaction volume today. But today we're talking about really sophisticated metrics like exchange flows, miner flows, like we're talking about something like whale dumping. These are some concepts that it was not easy to be like measured in classic markets. So yes, this is a really sophisticated field. It is evolving. It is pretty new. Even you see a lot of posts about it. But this is a really exciting field, and I really like to talk about it with you guys today. And as we go on, I try to open this topic and tell you what happened to me to become an on-chain analyst.
That sounds great. That sounds great.
Yeah.
Please continue. Please continue.
Yes. So if I want to put it in a picture, thanks to the ARK investment for putting this beautiful chart there, I think there are three main categories if I want to divide the audiences of this on-chain data. Like the base layer is just a stakeholder or observer who just care about the basic information. What is the hash rate? What is the security level of the network? What is the volume? What is the utility of this network? So the basic information that we need about a financial ecosystem like Bitcoin are all possible to be found in on-chain data, but they're not necessarily used by traders and just other like people that are involved more and more. But these are the basic information that you need to know about a network like Bitcoin. Like how healthy is the system? Do we see the hash rate or computation power of the network growing? And do we see the active number of usages growing or not? So these are all falling under the on-chain data. But the second layer that I'm really interested to is the data that is needed or required by the buyers and sellers, people who have a skin in the game, people who wants to know who is buying, what is the accumulation of system, what is the wealth distribution in this system. So when you go up in this hierarchy, when you go up in this like levels, you get to more complex metrics. You get to know some facts about this ecosystem that it was not possible to be measured in classic markets. Like, let's say in a gold market, we want to know if the big entities are accumulating. As a stakeholder in this market, I believe I have the right to know what is happening about the resources. Or let's get back to other currencies like fiat currencies. One of the things that's happening is the dilution that is happening without the stakeholders' permission. But in this system, you have the ability to check every aspect of this ledger named Bitcoin, 10 minutes, 10 minutes, like I mean, in each block. And there is no privilege for one person to other person. So this is really fascinating to me. This transparency in this system actually showed itself through on-chain. And I can tell in the future, the macroeconomists in this ecosystem are going to be the on-chain data analysts. Because some sentences you hear in on-chain data posts, like they talk about inflation, they talk about the supply shock. If you like be just a little bit keen to know what is the resemblance between Bitcoin ecosystem and classic ecosystem, you will find these words in the like treasury, the secretaries and the politician talk about the fiat system when they have like in a speech to talk about these words, and you can see those words in the on-chain data analyst post. So this is what is striking me as well. These macroeconomic perspectives are going to be given to the participant in this market just by on-chain data. So I think this is really fascinating to me at least, and I believe in the near future everyone will talk about them. It might be a little bit new, but it is growing. So yeah, these are three layers of audiences. They all have to use the on-chain data, and the complexity of the metrics will increase as you go up because they need more inputs, more complex data from the on-chain data, and this is really really growing. And these are the metrics that we have today, and I'm sure as we go on, as we face different challenges in data analysis, we're going to have new metrics, new on-chain analysis, and this is growing, and we're just at the beginning, like Bitcoin itself. These are just, for example, that we had it in 2000, probably 12. Like we had some charts and like websites that talk about the hash rate, what is the active address count, what is the block reward, and these are the information that helped the other on-chain data analysts to use this one and make this second layer that I was talking about. They use the basic information that on-chain data was providing, a ledger was providing, and develop the higher level of these data, like the huddle waves. And I'm going to talk about them like later in this podcast. But these are the basic information that was used to develop new metrics. So the story started 2011. The basic data was developed. Then the new participant, like the entities, like the active asset managers, they came into the game and they required different data. So I'm going to talk about them later about the new data. But the main the first one that like was the biggest one, I think, at least to me, it was the NVT. This metric was the biggest one when it came out, and I remember when it was published on the Medium website, and then everyone were talking about the on-chain data. Like, I mean, by everyone, I mean the academic people, the ones that were early into the market. So the big ones were talking about it, and I really want to talk about this today if you don't have any questions so far.
Thank you. That's a great introduction. Clearly,
Sure.
you're very pro on-chain data. I was just wondering, from a beginner's perspective, how much of this data would you say is noise and that you have to filter it, or would you say that a lot of it is just relevant for these tier two models, like you mentioned? And secondly, I just wanted to kind of ask, so when you're kind of creating these models, there are some assumptions that people have to take when they move forward, when they incorporate some of these metrics into a model. There are some assumptions they make as to their authenticity and their reliability. So do you think that since all of this is on chain, do you think that it's a very small, minor percentage of data points that need some kind of filtering, or do you think that there are only a handful of metrics that are really useful in more sophisticated models?
Well, that is a question that I think everyone should answer before getting into on-chain. And I really thank you about like mentioning this question, because even me, when I started, I was doing some wrong analysis because I was new into this. The first problem, if I want to just review my experience, like I'll try to put myself in the shoe of a newcomer into this field. The first problem that people might the first mistake they might make is looking at this data like a technical analysis. Like they put like support level into the metrics. They try to look at it as a volume data from exchanges. This is totally different. Like you said, we have to separate the noise from the main data. Like this is the first step. Like I prepared the example here. I'm sure all of you and all of our audiences saw this Telegram groups and notification about the whale alert, which they are reporting the right data. I'm not saying the data is wrong, but the interpretation and utilizing those data is being done wrongfully. Why? Because I'm just bringing an example here. Look, we have a metric, and it is pretty well known now. It's called all exchange net flow, which is basically just showing what is the net flow. Like when we have a positive bar here, that means we have a big inflow into all exchanges. When we have a negative bar here, we have a really big outflow from the exchanges. So people tend to react to these inflows and outflows really fast in a short time frame. And I'm sure you faced it. Like you get a notification in your Telegram, 10,000 Bitcoin will be like withdrawn from exchange A, B, C. And they are reporting the right data, like I said. But this is not the right way to look at it like a technical analyst or like a person that is reacting to short-term data. We have to be like in smart, I would say smart, but probably professional is the right word. But you have to be professional, look at it. Like for example, for this specific data, we have to look at the aggregated data, because there are lots of examples. We had a big like outflow from the, like look at this top we had in May and April. We have a lot of outflows, but the still market had a really big crash. Or like from here, like we had a big outflow, we still had like a really, like I think 15% or 14% drop into the market. So we cannot look at it linearly. We have to be considering like more metrics together. This example itself, I draw another model, and I made another model based on this data, which is basically looking at the aggregated data for 180 days. So instead of looking at one single day data point, we look at the 6 month aggregated data. And as you can see, there is a divergence between the inflows or like Bitcoin coming into the system and with the price. As you can see, when we started to see a depletion in the reserves at the exchange, which is a result of the outflows, continuous outflow from the exchanges, we can see the price like start to increase. Why? Because we had a supply shock. And the same time, as soon as we saw this momentum is losing its like level, and it's just the intensity is decreasing and decreasing, price start to lose its momentum. So I'm not saying this model is going to be valid forever. That's the other thing about on-chain data. As soon as you developed a model, as soon as you found out this like relationship between these two metrics is valid, you have to check it back. You have to check it against other analysts. So because it's a really, really new field of study, and people have to be considered about it. One thing I can say for sure, I think on-chain data for traders and for people who wants to do trading in short term, they have to use some computational tools. It could be a computer. That's why if you look at most of data on-chain data providers, they have an API and they provide lots of metrics together. I believe for a short-term trader who wants to speculate about price, on-chain data is a powerful tool if you use it as a computer, if you use it as a PC, because human mind tend to look at everything linearly. This increase, that's increasing. There is a divergence, there is a convergence. So this level of analyzing from a human perspective is not enough for on-chain data. But if you're looking at longer time frame, I do believe on-chain is enough for the investors who wants to just buy when Bitcoin is cheap, and I'm going to explain why I use this term, and sell when the market is overheated, but not in an hourly or daily um, time frame. It could be midterm to long term. But this is my just personal idea. There are some traders that claim they use on-chain data and they're like just their performance is much better. Me personally, I use it and I'm gonna use it for midterm investment, like in matter of months or seasons, getting into the market and I start to cash out partially. So that's the answer to your question about noise and how we have to use it. I thought this example could tell the story, what could be wrong and what could be wrong, right when we use on-chain data.
So we've been talking about the flows away from to and from exchanges. I'm wondering how useful on-chain data can be as more and more volume moves away from the traditional sort of crypto exchanges that we've had and into like these investment products like GBTC and through ETFs in Canada, physical ETFs, and even the recently passed futures ETF. Do you think that the relevance of on-chain data is still there as greater volume moves towards these sort of closed shops?
Well, that's one of my concern as well. The short question is going to be, I'm sure in long term, I mean in order of months and in order of like one cycle, if we have any cycle in the future, because there is other thing. I have to open a parenthesis here. There is that another division happening into this field, and there are cycle maximalists and cycle not maximal, the people who don't believe in this 4-year cycle is going to happen or not. So let's put that aside. I do believe in order of years and in order of month time frames, that's not going to change the story, because even those ETFs, even those entities who are trying to do ETFs, a spot ETF, whatever they are doing, we can still track at least their belonging, how much they're stacking. Are they cashing out into the spot market? Like for long term, I do believe for longer terms that we have into trading or investment, I do believe on-chain data would help. Even now, you can track how much GBTC has, or if the clustering, because there is this thing happening into the on-chain data, and they're trying to cluster the addresses, entities, and this might be a little bit against the privacy, but at least they're trying to find out what is this entity doing. And as soon as they label it as a like specific exchange or that entity XY, they still can track how much Bitcoin they have if they are selling into the spot market. So yes, it's going to be a little bit limited when it comes to this kind of analysis, but I do believe a big portion of transaction stays on chain. We didn't get to that level that the governments and big entities try to just hold it forever. They have to cash out, and miners as well. We have 2 million, 2.5 million, I think, close to 2.5 million Bitcoin left, and we have a lot of private and like individuals mining into the system. They have to distribute. So as far as we are mining, I do believe we have new Bitcoins to be distributed, and we can track their behavior. They are affecting to the market. They are affecting the market. So on-chain analysts can follow their behavior as well. So for midterm, I think as far as we are alive, on-chain data would be good. But after mining ended, I don't know. I don't know what's going to happen. What is the dynamic of the network?
I'm curious about. Well, I have a question. So, I personally sort of believe that as we go into 2022, the dominant kind of mainstream narrative, and even like industry narrative as well, may be the Mt. Gox situation and
Mm-hmm.
the fear of the selling of the mass amount of Mt. Gox coins on the open market. Is there any way to sort of examine this, not necessarily today, but as we get closer to that date? Is there any way that on-chain data could provide perhaps clues or any sort of insight into whether or not this fear will be realized, whether or not there will be sort of a mass dumping, or whether or not these coins are already being sold in advance to interested investors before they're even capable of being sold anyways. They're being sold sort of pre-sale, if you will. Is there any on-chain data to kind of track this or just examine this story?
I heard about it. Like they labeled the addresses that are attributed to that specific exchange. So if that's true, because I didn't personally check the balance of those addresses, but I do believe, and I read the articles that they labeled, and okay, this address is this public address is belonging to that exchange. So you can check that address, and I'm sure there are lots of bots being written, like the active bots are recording the ledger, and they are looking at a specific address. As soon as once like Satoshi move from that address, I'm sure that's going to be headline all over the news. But the decision they make about selling it in advance, don't touching it in the cold wallet before they move it out of those wallets, we cannot figure out unless official people like the politician or the people who are in charge of that like wallet announce something. But without moving it out from that wallet, on-chain data can help. But as soon as it moved out, 10 minutes after, I'm sure it's going to be all over the news. And I believe there's two websites lively following what's going to happen to those. I don't have the addresses in my mind, but on-chain data is the answer. Even an ordinary person can have its own node, a little bit challenging in terms of coding, but in terms of privilege, there is no privilege here. Everyone can have access to that data. Write a Python code, and every 10 minutes, check that specific address and see, like an explorer, check that address. If anything happens to that, get an alert and be like, do whatever they think is the right decision. To me, it is not going to affect the market to the long term, but if you're a speculative person and you want to sell out as soon as you get the news, I think that's not a hard work to do.
Sounds good. So
Yep.
please continue, Z,
Yeah.
with yeah.
Yeah, I get a lot of this question about how you compare technical analysis, fundamental analysis, and on-chain analysis, because there are some mixing happening here, and everyone have a different answer to this question based on their background, the way the pathway they just went through to be one of these analysts. Like you can see, like 90%. I don't have a statistic exact number, a statistical number. That's how many of them are technical analysts, but I think all of us can agree on this that the majority are interested in technical analysts, and the on-chain is evolving and it's still like really early. I just know like 5 or 6 on-chain analysts on Twitter that I follow, and they're doing. I try to put the differences in one picture. So as you can see, this picture is speaking itself. I believe the technical analyst is trying to speculate the small movements and the fluctuation of the price. So in technical analysis, we're talking about price. We're talking about the exchanges trade volume, which I believe it is not being faulted on purpose, but it is manipulative. These order books, they are not easy. You cannot just jump in and say, okay, exchange XYZ having this $2 million volume with Bitcoin. That's not reliable, and there are lots of outlets trying to estimate the right volume. So in technical analysis, we try to use price. We talk about the volume on exchanges. We try to speculate. We try to history match the patterns. You hear a lot of names into the when it comes to the technical analysis. I don't know what are the names. I'm not really interested and really didn't study them. But we're talking about patterns. We're speculating. We're talking about short-term behavior of the market. Market data is our source. But when it comes to on-chain data, we are trying to, I can't say speculate, because we are evaluating the market's psychological cycles. If I want to put it in one sentence, so the black line is what we're trying to figure out in on-chain data. And as you can see in on-chain data, we are talking about value of the asset, not the price. Like there are lots of today, especially after the market, I think market is dropping hard now. There are a lot of comments and like criticism about Plan B, like his model, because the data he used is the basic data from on-chain data, and he built his model. People have to remember the on-chain data is trying to come up with a model. So we're not necessarily looking for pattern. We're talking about models to value an asset, which is Bitcoin, which is possible at the moment for Bitcoin. For other assets, a little bit challenging, but in Bitcoin, we're trying to value, if like put a value in this asset. Price can be like overheated because of the greed, because of the like they call it hope into the market or euphoria phase. Price could be above of the value, but for investors like Warren Buffett who are value investing, the question is not the price. The question is what is the value of the asset, and that's where on-chain data can help. In on-chain data, we try to come up with models. It's NVT model, it's MVRV model, it's Plan B S2FX model. There are lots of models that are trying to value the asset based on the utility of that asset. So today, the value of the Bitcoin from Model A, I don't want to just emphasize on any specific model, but the model I use, for example, is just giving this value to the Bitcoin is 53,000, 55, or 60,000, whatever. When the price drops below that value, as an investor, that's where I am encouraged to invest in. So that's the difference between on-chain analysis and technical. Technical trying to use the fluctuation and it wants to use this fluctuation to just make some money. But the investors need when to buy, and the answer is when it's cheap. So in order to figure out when it's cheap, you have to evaluate this asset. So that's where the data is coming from. And the other thing is, I emphasize on the time frame. In on-chain, we're talking about midterm versus fundamental that we're talking about really long term. That's the big difference between fundamental and on-chain, because these two might be confused as well. Someone believe on-chain is fundamental as well, but I do believe there are lots of differences, and that's my view. And a lot of people can be like against this, but yeah, I think this way. And technical analysis might not be happy about this, but I think on-chain data is going to save you a lot of time if you are not a daily trader, if your job is not to be a trader.
Yeah, on that note, I'm wondering, do you think that on-chain data can be or even has in the past been used to, let's say, trick technical analysts, right? Or people who speculate on short-term timeframes? I mean, there's been specific examples in the past of large exchange inflows that have like sparked a bit of fear into the market when in reality there was probably no fear to be had because they were, like you mentioned whale alert before, they were perhaps even just internal transfers that just were mislabeled or not labeled at all. I believe in the past there was a big one in which there was a large inflow into Gemini, but I may be mistaken, but I believe it was just BlockFi because
Oh,
they
I
use
remember
Gemini
that.
as a
Yeah.
custodian. Yeah, and
Yeah.
that caused a bit of drama in the market for a couple days or
Yeah.
something.
Yeah.
But so, do you think that maybe let's say whales or large holders or something uh, can use inflows and other on-chain metrics to influence short-term, immediate-term market sentiment?
Well, it's a bold claim to make, but I do believe in it. Yes, because it's hard to prove that someone is doing that transaction. Especially some of them have to pay a large amount of fee to do so. If I want to just put it in simple way, I just say if you find any type of on-chain data that is available for free, broadcasted 24/7, just be a little bit pessimistic about it, including the flow data to the exchange and those stuff. Because those things, the data is not wrong. I have to say it again. The data is right, but the time that movement is happening, that transaction happening in a in actually wrong moment to the people. If you want to value those like transaction, if you want to just give some credit to those one and make a decision based on one single data point, I think it's the person's fault. It will affect the market, and it's been proven being effective, especially that specific one you just mentioned. It was one of the early ones, and it really affected the market. But as you go on, I don't know, is it people around me or is it just the whole community? They are learning that no, this data might be right, but it's a piece of puzzle. I can call it manipulating the market, but there are lots of more formal name for it. I think this is the problem with the people who use the data, not the problem with the data itself. You're right. They are doing it, to me at least, they're doing it to affect the market sentiment. Imagine Bitcoin is dropping 5%. Why, like that's the question I ask from my audience. Why do you think a whale that could distribute 1 month ago on a peak, on a really high price, is all of a sudden deciding to send 10,000 Bitcoin when the market is dropping? Every dollar and if that 10,000 comes to the order book, the price is going to go to really, really lower prices. So it depends. We have, like, as an on-chain analyst, one of the things I really focus on is to tell people, teach people, do not look at one piece of the puzzle. Look at the whole thing, So still, they're effective. They can manipulate the participants' perspective and sentiment, but they cannot manipulate the data itself. That's the point I want to make. The data is right. They're moving it for 100% because not only CQ and other data providers are checking, there are individuals like a person, like a student. I saw some students on Twitter, they have their own node and they're starting to have their own on-chain data. So there is no way to make a fake move on this blockchain. So data is right. It is us that we are using it in the wrong way.
So just had a quick question about this.
Sure.
So can we say that on-chain data is giving traders an edge? Traders who read it right, or traders who interpret the data right, they have an edge, right?
Yes.
Okay. So
Yes.
if we talk about...
Yeah.
Yeah, no, sorry, go on.
Yeah. Well, I want to make it an example. Me and some of my friends, we're using the API. By API, I mean, if you want to use, like, CryptoQuant is giving 100 or 120 of different metrics, okay? And every 10 minutes, that data being updated. There is no way, as a person, you look at all those metrics and make a decision. So at the end of the day, if you are a short-term speculator, you have to look at at least 20 or 25, because there is some correlation between these metrics. First of all, you have to just separate the ones that have no correlation with others. You have to fit this to a model, like a machine learning models or computer models, like there are different names for it, but machine learning models, and try to match the previous price fluctuation with the behavior of these specific metrics that you chosen as a feed of your model. So I am working with a couple of teams. They are trying to do so, and so far the only thing that I can confirm that it happened is any big drop into the market usually comes after the big holders, or they call them the hodlers or the whales or big entities, start to distribute. And as soon as their momentum is lost, and you see they're not distributing on a high rate, you can see the price is start losing its moment. So what we are trying to do, not trying to predict the next 15 minutes candle, but we are trying to predict the trend, the midterm trend. So if you are a trader and you know the midterm trend is becoming bearish, if you are a future trader, for example, you do not try to outsmart the market and start to long the market, So traders can use it as an extra tool to make some decision more data driven. So instead of speculating, look at the sentiment of the Twitter, the market might be bearish, you can confirm that mentality with on-chain data, but you need a team. You cannot do it personally. One person, I think it is hard. And for traders, they have to group up and come up with a tool and do it. And I think in the future, there are lots of companies coming out saying we develop this model based on on-chain data to predict the market's behavior in daily time frame. I assume it's going to happen soon.
Right. So thank you for that, and because that kind of connects to the second question that I was going to ask you. So if this is an edge, let's say, and we can also kind of talk about, let's say, Wyckoff's composite man or smart money or whatever we want to call that. So retail will 80 to 90% of the time retail will lose money, and that is because not everybody can win this trading game, right? Somebody has to lose for other people to win. So if this is an edge, And like you said, everybody has access to it, and that access is kind of becoming more uniform. If everybody knows, and I'll take the example of Plan B's model. So if everybody has access to the same information, if everybody has access to the same models and same projections, how do you see the market playing out? Then how can anybody win? Like an edge ceases to be an edge when everybody has it, right? So how do you kind of reconcile that?
Well, that's gonna evolve. That's a really good question. Like we have this metric called MVRV, for example, or we have this metric. I think I have, yes, I have this metric here. Like it shows what is the intensity of the profit being realized in the market. Like I want to make this an example to answer your question. So if you were in 2018 have this kind of data and to like, I don't know, somehow, because there were no data provided. You couldn't have access to this if you didn't know much programming. It was really hard. But you could look at this and compare it with 2013 and 14 and see that's the top. Everyone, including me myself, when we were close to 64, I was expecting spikes like this and then say, okay, call it, that's the top. But we got all surprised. So I do believe the thing is happening is the smart monies have had access to this. They are developing their own model. So every time we try to outsmart the market in short terms, by short term I mean daily or weekly, we're going to lose the game at the end of the game as a retailer because they have made their own model. They are way advanced in computation like tools. So what I can suggest to people who are using on-chain data, if you increase your time frame, this on-chain data is going to help you to do not make the wrong decision. I can put it this way. Let's talk about when we hit the 30,000. I cannot speak for everyone, but the sentiment in technical analysis, they were calling for 20, for 10. Like the prices was crazy. And if I was in 2017, if I was the same person looking at the Twitter, I'm sure I would cash out 100%. But on-chain was screaming at 30,000 that the big entities are accumulating like there is no tomorrow. So in those kind of moments, the like small retailers, the small investor can use the on-chain data to avoid the wrong decision. By wrong decision, I mean getting played out by the big entities. When the news is selling, everyone are selling. That's the news. Oh, Bitcoin is just gonna end. And at the same time, you see entities who had like 10,000 or thousands of Bitcoin are accumulating. So you should ask yourself, are they, excuse my French, are they like stupid? They're like spending millions of dollars for accumulating more. So on-chain data is going to help you there. But in terms of speculating short terms, I do believe if you don't have the enough tools and you don't have enough resources, yes, they're going to outsmart us by their tools, by the data scientists. Like I made an example. I was waiting for, because this metric, the red one on the right, is just showing how big is the intensity of the profit being realized. I was like in Twitter fighting with the bears and saying, no, that's not the top. This is just the beginning of the market. But all of a sudden, bam, you're at 30,000. After then, I learned Bitcoin on-chain data is going to help me to avoid the wrong decision, not be the sole tool to just trade in daily basis. So I hope I answered your question.
Yeah.
Yeah.
So I'm quite interested in the mining industry and their flows and how they appear on chain. And I'm wondering, in the shift between, obviously the mining industry has been shook up quite a lot this year with China banning Bitcoin mining, and a lot of miners have moved elsewhere. And you've now got these great big US publicly traded companies who are mining on behalf of investors almost. I'm wondering if on-chain data has shown any shifts in sort of miner outflows and how much miners are actually selling versus just how much miners are selling.
Well, your mind will blow now if everyone are asking me like, what is the biggest thing you see in this cycle happening? I wanted to talk about like on-chain data is coming to the market and people are being like more wise and wise, but I changed it after the China like fought to change the answer to miners. If someone asks me what is the most fascinating thing happening in this cycle, what is it? I just have to right off the bat say the miners' behavior. Like, look at this chart. It is showing the reserve that's been held by the miners, and this is 2017's top. That's 2019's mid-cycle top. As you can see, miners were mostly individual or small entities who had to cash out. Well, they tried to do it at the best time, but they couldn't wait a long time because they had to upgrade their hardwares. They have to just change their system as fast as possible because the hash rate was increasing, and they have to have a new mining system. So this is change. Look at this cycle. So they were accumulating at the beginning, and at the 42,000 at the, I think it was January or end of January 2021, I believe that's the time we had a drop. That's the biggest distribution they had. But since then, they're not distributing anymore. I do believe the reason is the investors in this industry, I mean the mining industry, is changed. It is now governed by the entities, or I could say governments, that have no problem with liquidity. They have the money to renew their machine anytime they want. They don't have to sell it at like right off the moment, and they're not looking for the high top prices to sell out. Look, they are accumulating. They had the chance to exit the market here at 64, and we are again at 64. We don't see a lot of outflows because they're not worried about the liquidity in the bearish market if we have a long bearish market. So this shift of like geographical shift, it made a big impact on the miners' behavior. I do believe they're not gonna, because in other, like in the previous cycles, they were the one, to me, they were the biggest sellers at the end of the cycle. Actually, they were the ones who ended the cycle based on my analysis. I could be wrong, but I do believe they were the one who sold as as fast as they could when they felt that's the last moment to get out. But in this top in 64, no, they were not like it. I do believe they just, what they care is to mine as much as they can, because I don't know, they're gonna be like held by spots. The government is gonna get into it. Their behavior is really changed, and let's see what happens, because this is what is gonna, based on my view, is gonna end the 4-year cycles. I do believe we're not gonna have a cycle like 2018, 2013, or 14, 2 years bearish market, 1 year so, and then 1 year having a really good bull market. I do believe it's going to be smaller cycles, both bearish and bullish, and the future market is not gonna, the sentiment stays the same way for 2 years. Futures market is another factor that is gonna change the dynamic of the system. We're gonna have like smaller bearish cycles. We're not gonna have super like peaks like here. I do believe that way. We're gonna have like a little bit damped when we are going to either direction like aggressively.
On the topic of on-chain data potentially being used in the short term, because of course I agree completely that it's incredibly useful for longer sort of trade mindsets like midterm and long term. On the short to midterm, one thing that I used to pay attention to quite a bit, I don't really anymore, was stablecoin issuances and burnings as well. I found in in the last bear market in like 2018, you would see quite a bit of Tether being especially the dominant stablecoin then, a lot of Tether being burned, which to me signaled a shift that there wasn't a lot of demand to buy Bitcoin or buy crypto. And then conversely, in the subsequent beginnings of a bull market, you would see Tether being, or other stablecoins being minted, especially on short-term dips in a longer uptrend. How do you feel about this sort of metric? Do you think that kind of monitoring stablecoin issuances versus burnings as being like a general indicator of market health, or when there's a short-term dip and then you immediately see an issuance, does that signal to you that it is indeed a short-term dip and that there are entities looking to buy? What's your interpretation of this?
Well, that's a big topic to work on, and I started like a couple of months ago to figure out what is the roadmap to just react to this kind of information. Like you said, if it was like before, issuance meant like they need liquidity to get into the market. But at the moment, we have different players into this market, and they are the future traders, the big futures market traders. At the moment, if I want to answer you, the only thing I'm certain about is I would suggest to follow the money. What is the destination? If it is the derivative exchanges, like any exchange that have derivative markets, and they're famous for being like a destination of the future market traders. If that's the destination, there are metrics that they're showing what is the percentage of the leverage like by tether or stable coins, and what is the percentage of the the money they put there, and they to leverage the money, the original money they put in down, and they start to leverage on top of it. If it is crypto and it is tether, there are two different stories. So when the destination of these stable coins are like those derivative exchanges, what I can say for sure, we're going to have volatility. I'm not going to say we're going to see jump or like any drop into the market. We're going to have volatility. And as a trader, what I'll do, if I am trading on high leverage, if I think I am really good in my speculation, I start to lower my margin. I start to hedge. If I have like a long put, if I have a big spot position, I start to do short. I start to open the short position on the future market. So what I'll do, use this data for, is just speculating, not about the price, about the volatility. I don't think it is like before when the tether being minted. That means we're gonna have the bull market, because we had a couple of incidents after the drop we had in April. We had a couple of minting, and the market was not moving at all. They probably were using it to play in the futures market. So it depends what's the destination. If it is a spot market, you can say with a high certainty that's going to be used to like just buying in the spot. But if it's like some other exchanges that are famous for futures and they have like high open interest, for those one, what I'll just suggest to people and my like audiences, start to lower your leverages and just lower your frequency of future trading, because that means volatility to me.
So, from this point onwards, do you think the last thing you want to talk about is perhaps where we are in the current cycle and what you're thinking from the price perspective, or where would you like to kind of end your analysis?
So we were talking about miners and how they are acting differently in this cycle, which fascinates me, and I'm sure that's the case for like a lot of on-chain data analysts, the way they're not selling. And also, I just want to mention again, this specific chart is another example of the higher level of the on-chain metrics. This one specifically is an oscillator that shows how intense is the real profit realizing by the market. Like let's say here, I just put some line here, some levels to just show the audience what is the intensity. For example, the 30% means in this point, market was experiencing up to 30% of the realized cap, which is the cost basis of the whole market being realized per day. That is a huge number. So we can see the dynamic is changing in this market, and we see this realization is happening at lower intensity, but over a longer time. That's a change in behavior. So we can see this complicated analysis done through on-chain data. Another metric that I really want to talk about, maybe today, if this goes, like if people see this today that the market is dropping, is like the SOPR. If that's another metric that measures what is the ratio of the profit that long-term holder are just realizing at a certain day. So SOPR is a spend output profit ratio, basically showing, like, let's say the long-term holders cost basis here, the price is 64 and their SOPR is around 8. It means their cost price for each Bitcoin costs them around 8,000, the long-term holder that are selling here. So this metric is giving us a ratio between the price that they purchased that Bitcoin or moved it last time, and between that price and the price we see in the market. As you can see, when we were at 64 in April and May, this metric was showing 8 to 9, and sometimes we had the sparks to 12. So that means the long-term holders were cashing out at 12 times higher than the price they paid for. But when we got to the all-time high again, we're seeing this thing is just around, this metric is showing around 3 to 4. This is not as low as bear market, but it is not overheated. So with using this specific chart, we can say this sentence that long-term holder accumulated here at the bottom, and they are not selling. By not selling, I don't mean there's no long-term holder. The aggregated behavior is like they are not cashing out yet. They're waiting for higher prices. But how long they're waiting, we have to monitor these metrics. And another complicated metrics I want to talk about is, I think all of you saw this fear and greed level on internet. Like they're reporting the level of fear is 89. Like they have different definition for that. Some of them are following the social media sentiment. Some of them are monitoring the dominance of the Bitcoin. But on-chain has an answer to that question as well. This metric, NUPL, which is net unrealized profit and loss, measures how much profit is potentially ready to be realized. They're not realized yet, but it can measure how much profit is being held by the participant, aggregated value. So at the market tops at 2017, this metric gets really close to 0.8, like the top we had here at the 64. As you can see, I wish I had the 2013, 14. In 2017 top, we hit that value. So they call it totally euphoria, super greed in the market. Like market is really greedy. Market tried to touch it at the top we had in May. We didn't cross it for a long time, but like 2013 and 14, because in 2013 and 14 we went through that zone. I mean above 0.8 twice. It looks like we are getting into that zone again, and that's why some of the on-chain data believe we are somehow repeating the 2014. We double top. So that's the structure that I do believe in it too. But the only difference I think we're going to see is the bear market after. I do believe the bear markets are going to be short, and all of them related to the FOD. I don't know what kind of FOD is going to be like on the news, but bear markets are going to be triggered by the FODs, and it's going to get intense with future market. I prepared this chart as well to complete my just review on on-chain data. I get a lot of questions, and I do believe lots of other on-chain analysts get this question. If you are super bullish, if on-chain data is totally bullish about midterm and long-term future, why we see it drop like this, 50% in the market? Why do we see these dips when we are clearly seeing the supply shock is really evident based on on-chain data? Why do we see these drops? Based on my knowledge, based on my analysis, I can answer the question by future market. I do believe the future market and the people who are the main traders in retailers who play in this game are not mature in terms of from financial perspective. They are taking a high risk, and that risk is biting them back. That's what's happening. So from drop to from 64 to 30, it is not just the spot market that been involved in price discovery. Futures market is just you could see if you go review the market. We had huge liquidation happening in the future market. So the money that's supposed to go to spot and buy Bitcoin and send it to cold storage being liquidated into the market, because it is us as a retailer who bring the main money into this market. Yes, the entities are bringing money, but we are the one who are willing to pay, especially in the bull markets, to pay any price for Bitcoin. When we get kicked out by getting liquidated, when we get kicked out by losing our money in future market, that's why we see the price is not being appreciated, because the on-chain data is positive. So the deviation between reality and price, with the value that's been estimated by on-chain data, the explanation I think is lying into the future market. Just look at the top we had. The funding rate was skyrocketing, see? But in CryptoQuant, me and my friend developed this sort of thing. We look at the funding rate to just somehow figure out what is the sentiment. Is market bullish about the future? If they are bullish, how bullish they are. If like look at this funding rate, their star rate, they were super bullish. At the same time, if you look at the momentum of the open interest, if you look at the tops here, if you look at the top here, we were seeing this sentiment of the future market is really, really bullish, but the open interest was increasing like crazy. The momentum of the OI or open interest or the volume of the open contracts in the future market was increasing really, really fast. So we came up with this metric, and it is available in the CryptoQuant. People can go look at it. We can map the major drops with these two metrics combined together. When we have like high funding rate, either positive or negative, like look at this bottom we had. We were seeing a really negative funding rate, and look at here. We saw this momentum is lost, and that's the RSI, 30-day RSI on the open interest, which shows the momentum of a variable. Here it is the open interest. We can map the major bottoms and tops using the like future market data, but we have to use the on-chain data and make sure the on-chain data stays bullish if it was before. So mixing the future data or option market data with on-chain data, I do believe traders can have a really powerful tools next to what they had before. So I believe technical analysis is really powerful tool, but it is not enough anymore. We have future market, we have entities. A spot market is sometimes really strong. You need on-chain data to confirm if the cycle is still bullish. Then use your technical skills to increase your performance. But if you want to be successful in long term, you need to know on-chain data. And nowadays, I believe option data and option markets data and futures market data as well. So yeah, if you want to be rich, you have to spend time and learn a lot of things. I know it's getting super complicated, but making money is not easy.
No, that's great, G. I had a quick question again.
Sure.
I was wondering, so when we look at all this aggregated data, it's aggregated, it's the whole market, right?
True.
And it doesn't differentiate between retail and smart money or the composite man. Do you think that matters at this point, or do you think that there needs to be some filtration of this data to see what retail is doing, and perhaps you counter trade that, and what smart money is doing, and perhaps you follow that? Do you think there's some reason to do that, or to just look at the data as an aggregated sample and infer from that?
So it is funny because most of the mistakes were being made by the short-term speculators and small entities. Well, what I suggest to people go, because you can differentiate the behavior of short-term holder, long-term holder, differentiate the behavior of the small investors. I mean, the size of their wallet is small, and the like large investors. You can differentiate those behaviors based on on-chain data. That's a valid statement. But in terms of suggestion, it might look funny, but I suggest follow those behaviors, do what retailers do not do what retailers do, and do what the smart money do. Like when we talk about distributing, if you look at the long-term holders' behavior, you can distribute, like let's say, like let's get back to this SOPR. So people like the short investors, when they get back, when you tell them you should have started to sell from here, like when they were like 30,000 to 60,000, they might laugh at you. Why would I sell at 30,000 and do not wait for 64? Because we didn't know we were going to get to 64. The long-term holders, the smart money we're distributing, if you want to be successful, try to change your behavior from the ones who made mistakes so far. Like the most of mistakes been made, I would say 100% mistakes were made by the short-term speculators, like a small investor. Do whatever. If I had the short-term SOPR, you would see the maximum profit ratio there just cashing out from market is 1.1, 1.2. The aggregated behavior of the short-term investors are realizing just 10%. Yes, we had a really successful trader who made like 600%, but that's a minority. So the suggestion is filter those data, and the on-chain data providers are really, really strong in that way. They are developing metrics for long-term holders, short-term, but try to act like the smart money, and the name being chosen like for a reason. The smart money because they're acting smart. They're distributing not at a specific price. They start to distribute in a range of time. Just look at this metric. Just it's crazy. And if they're not distributing now, turn off the social media. Look at the on-chain data. I know price might look like crazy if you don't have a 25x futures market position open. Do not be scared. That's the financial advice. Because everyone say that's not in the financial advice, but to me it is. Just look at the smart money, distribute with them, and accumulate with them. That's what I learned from on-chain data.
Great. Yeah. That's super insightful, Z. One last really important question.
Sure.
Can we start a private Telegram group and you send us signals for the bottom and the top? just let us know, because
Sure.
this has been really insightful. Thank you. I think we've all learned a lot, and
I
this
need
has
something
been
though. I need
yeah.
something though in return. If I have access to the order book of OKX, because if I have access to order book, I can tell you like, that's the piece of the puzzle that I don't have. I need the order book data to put it next to this, and I tell you what's the bottom.
Got it. I think we can take that offline and see what we can come up with. So thank you, Z. That was super insightful. We all learned a lot. Amazing analysis, and you've explained the metrics and the general science behind on-chain really well. We'd love to have you again, perhaps at the next market top or bottom, and then you can give your comments. So I'll wrap it up now. Thank you, and that's it for today. Thank you all for joining us. This was a really insightful episode. If you liked it, don't forget to like and share the episode and subscribe to our channels. You can watch more of our episodes from Send It on YouTube and listen to them on Apple Podcasts. And with that, we're going to sign off until next time.
Also, ring the notification bell on YouTube if you're watching on YouTube.
Yep.
It
Do
matters. It matters. Yeah.
Do that.
Thank you guys for having me. It was a great pleasure. Rick, Adam, Hunain.
For
Thanks,
sure.
it's
Thank
been
you.
great.
Thank you very much for coming on. I mean, it was
My
awesome
pleasure.
chat. Awesome chat.
Yeah.
Well,
Yeah.
my pleasure.